You know, markets have been bad recently. I get it. Everything seems to be coming down ferociously. And you may be thinking, what is the best strategy for you moving forward? Should you put a lump sum in, or should you do dollar cost averaging? This has been an eternal topic. And just nice, I happened to see this article by Dollars and Cents. STI and S&P 500. How much you would have gained or lost if you started investing in 2021 using dollar cost averaging. In this article, which I'll leave links below, they compared using 10,000 lump sum as of 1st of January versus doing it equal amounts for 12 months, which is $833.33. The results have been surprising, and I'll actually share them with you in detail, and not only that, I'll give you my extra interpretation of how you can use it to your advantage. And with that, let's roll in the intro video. Hi guys, welcome back. If you are a new investor, I think these findings are going to help you a lot. And let's dive onto it. What you see over here is if you had invested $833.33 each month into S&P 500 in the year of 2021, you would have gained $1,377, which is 13.77%. And how it works is when you buy in January with that equal amount of 833.33, when the S&P 500 is 3,700 points, you would have bought 22.51 units or possibly an ETF that tracks that index. And conversely, when the level goes up higher to 3,773, with the same amount invested, you would have bought less units. So that's the whole idea of dollar cost averaging. When the price goes up, your same amount buys less. Conversely, when the price goes down, your same amount buys more. And let's recap, the gain is total of 13.77%. Now let's compare to their findings if you had done a lump sum investment in S&P 500 as of start of 2021. That amount of $10,000, because S&P has grown significantly, would become 12,879%, which is a 28.8% gain. Again, the caveat as I'll highlight over here is if you had ridden the full wave of the bull market in 2021. This is a crucial factor, which I'll explain in a quick while. You know, markets are traditionally up. 70% of time up, which means logically when you buy lump sum, it definitely makes sense because 70% you're going to be better off than dollar cost averaging, which you buy gradually. But there are emotional factors to things. Let me elaborate on what could happen. I don't know if you have this experience before. You bought in markets like this example. On 1st of January, you enter S&P 500 at a level of 3,700 as in this example. The markets continue to trend up, and in the next few months, you kind of wish that you had put in more right at the start. As of March, you have actually gained quite a bit because now the S&P 500 is 3,901 already. You'll be thinking, hey, should I lock in gains? But you didn't. You followed some of the advice, which is to have diamond hands, hold on to things. Then suddenly, there was a bit of negative news. The growth kind of stalled already. Previously, it was growing rapidly, but right now, it seems to be flattish. This is the slowest gain in months. Now you'll be thinking, nobody went broke in financial markets cashing out gains, correct? That is true, and that's why you decided to sell off. And you actually locked in your gains of 8.6%, all in a short span of 4 months. Congratulations, there is actually some gain, better than nothing. So you're thinking of buying the dip. If S&P 500 goes below 4,000, maybe you'll get back into the markets. And that's why you sit on the sideline with your cash. But hey, surprisingly, things started to look good again on the markets. For no reason, markets sprang up by another 4% to 4,192 on the index itself. It's a bitter pill to swallow. You originally wanted to wait for it to dip first before re-entering. Maybe it just needs time. So you continue to wait with your cash on the sideline. Each and every month passed and S&P 500 made new highs. Finally, in October, we see a first drop in the market. You're convinced that the level 4,000 will come, and by then, you can re-enter the market. But hey, this dip wasn't long lasting. Markets continued to head up, and as of December 31st, it ended the year at 4,766. I can tell this story because I've made this mistake myself before. And there are a few lessons which I'd like to share with you. The first is time in the market is actually true. Selling out in April with an 8.6% gain is cool, but missing out on the total gains of almost 29% for the year really hurts. Bear in mind, this is a bull market. Even if you have dollar cost averaged, as we mentioned just now, you still have 13.77%, which is still better than the 8.6% you cashed out in April and sat with cash. But let's expand the story a bit further. Say for example, 1st of January 2022, you want to get invested again. You've read some of the news articles. Hey, maybe markets really are strong. You kind of missed out on a bit. Last year was a good year, but you want to repeat that process of getting gains, correct? So you invested your amounts of $10,860 back into the market, and now the market is at 4,766 on the S&P 500. The idea is to ride it out and hopefully cash out, exit the market before any crash happens. But as we know, what happened? Markets came down severely, correct? And with this newly invested value, all your gains from last year have been wiped out already. The question now is, should you quickly exit before the pain becomes unbearable? That leads to lesson number 2. Timing the market is really hard. You won't be able to exit market crashes, and crashes happen very fast. If you exit at every point the market is lower, you realize that you'll be cutting losses too frequently, and that is actually damaging to your investment returns. The key lesson is downturns cannot be avoided. And avoiding downturns is not even the point of investing. Good investment is riding it up and down sufficiently long. And if you resonate with the message, smash on like button. In that case, it's taken our team hours to prepare this content for you, and hopefully it is of great benefit. Now let's move on to lesson number 3. Just now I mentioned on the idea of buying the dip, correct? You sold out at 4,000 plus, you're hoping to rebuy it at a lower point less than 4,000. This meme is actually pretty interesting. You trying to buy dips, but your bank account just holds you back. Because the $1 million question is, how low is low enough? Is there a dip that is reasonable? If we flash back the chart of S&P 500, we realize that we are very far away from $4,000 as a level already. How low is low? Are you comparing it to 4,007? Are you comparing it to 4,005? The answer is very difficult. There are several articles that reinforce the idea of buying the dip is actually a bad idea. This message over here is very important. If you wanted to invest late last year but wanted to wait for a 5% plus dip, you have missed out on the 30% rally. Another article also mentioned, buying the dip is a horrible stock market strategy. And this probably relates to our case. For an investor from the 1980s to 2000, dollar cost averaging would have outperformed buying the dip massively, because in the last 20 years, there were no dips that were more than 50%. Hence, an investor would have forever been in cash and never gotten invested. This needs to be avoided. Money in your bank account can get scammed away, like what we know, and in any case is eroded by inflation. So you need to get your cash invested to protect your wealth and especially to reach your financial goals. Let's move on to more findings from the Dollars and Cents article. They've also found out that dollar cost averaging into STI for a year of 2021 didn't yield too much of a return. In fact, the total gains were only $137, which equates to 1.37%. Their findings suggested that dollar cost averaging as a strategy tends to perform better in market volatility, and STI was relatively flat for the whole year. While it was relatively flat, it still trended up a little, which means a lump sum investment into STI actually had a gain of about 9%. This leads to the 4th lesson to discuss today. In areas where there are low volatility, it's probably better to do lump sum investing. Because when prices don't move too much, dollar cost averaging is a waste of time. That typically applies a lot to bond funds where volatility is low. And on the other extreme, we can put in cryptocurrencies, whose price changes can be 5 to 30% on any given day. This finding tells us that lump sum investing into cryptocurrencies is probably a bad idea. If you're keen on cryptocurrencies with its massive price volatility, you are much better off dollar cost averaging. Again, if any of the points have benefited you, smash on the like button. Let's move on to the 5th lesson, something that I've found doing an experiment on my own. I've actually done this previous video on dollar cost averaging 1,000 per week into Chinese tech. And in that video I've actually shared before, because prices fluctuated and went lower on the overall trend, I've actually managed to accumulate things at a lower point, and that definitely helped reduce my break-even point. In that video, my last purchase in was 10th of January. And if we fast forward to today, there are new entry points that I can show you right here. As of now, this strategy still beats lump sum investing, and I'll continue to monitor it. So if you're keen on the findings, smash or subscribe. I'll do a review in the subsequent few months ahead. So having spoken to you here, let's round up things a bit. The first is that if you are doing lump sum investing into stocks, you've done before valuations and you feel that a company you have analyzed is undervalued, lump sum investing can work. On the other hand, if you are buying markets, you're doing a portfolio, then probably dollar cost averaging works because you don't know whether markets are trending up, sideways, or downwards. Dollar cost averaging has a lot of merit. In a bull market, we've seen that returns are slightly lower than a lump sum investing, but you can avoid any temptation of market timing. And you can even avoid this concept of buying the dip. In a flat market, yes, it's true, it doesn't show that much of a benefit. It's probably the only place where it doesn't really make sense. And on a down market, you realize that it allows you to pick up things consistently, lowering your costs automatically and giving you peace of mind when it comes to investing. So that's my main message for today. If you are new to investing, do a lot of dollar cost averaging. It will help you remove the emotional factor away from your investment journey. Thank you for watching to here, and as always, check out some of the previous videos I've done before that can help you in your investment journey. I'll sign off from here and see you next one. Take care and goodbye.